have the ability to get something, invest something 4%, and it's less risky than something else that also 4%, you're going to pick the one with lower risk. Common stock. This is basically, used to be in paper form, now it's all electronic. It's fairly useless in and of itself. You can't really do much with it, other than what other people value it for, which has historically kind of been accepted as being the future expected dividends, which is the dividends that pay out in the future minus the cost of waiting for them to come. So now we have markets. This is the New York Stock Exchange in New York City. Not that much trading actually goes on here. It's automated nowadays. There's no bids, there's no offers. Everything goes through the brokerages. There's international indexes or there's exchanges, but they're fairly well correlated. Now here's some terminology. Bulls and bears. Bulls are generally more aggressive. They're the ones that think the stock market's going to rise. Bears are the ones that think the stock market's going to go down. It's generally thought of as bulls being the optimists and bears being the pessimists. Bears are generally known to ruin the party. So stock prices. What causes a stock to have a certain price? As I said before, some people believe, and historically believe, that stocks are reflective of future dividends. But nowadays, because of the emotion involved, because of the volume involved, a lot of it is just what you think the price is going to be at tomorrow. Stock is not trading based on the company's value, it's trading on what other people value it at. So guts and emotions, animal spirits. This is something that has really been big in economics and humanities recently. Behavioral economics. Humans are not, as economics have often like to believe in their simple equations, rational. We get very emotional when we are emotional. We're not rational when we make stupid decisions. So what does this mean? Well, you can have a lot of problems. This slide is kind of trying to illustrate leverage. Leverage is kind of what made the recent financial crisis extremely bad. Leverage is basically trying to multiply your earnings or your losses through perhaps leveraging an asset you have. So the banks were leveraging on $1 of what they had, they went to $40 of assets. So, basic strategies. Buy and hold is one that everyone goes, oh yay. If you look at it historically, it looks like the stock market just keeps going up. But if you look at it, or if you think about it, there's survivorship bias. Basically, companies die. They don't show up in the index after they die. So what you get reflected is just all this growth that doesn't really take into account things hitting zero. Mutual funds are another interesting thing people like. You have the survivorship bias here again. People look at mutual funds, they look at, oh, they're so successful. That's because you can't look at, or it's not usually presented to you, all the ones that hit zero. And as the mutual fund documentation likes to say, past performance isn't that great an indicator of future performance. So we have the EMH, the efficient market hypothesis. This is the classical view that because markets are so informationally efficient, there's no way any person could consistently make money in the market. And perhaps the conclusion is correct, but the way you get to the conclusion that everything is efficient seems to have some problems. So behavioral economics, finance again. There's a lot of phenomena that seems to show that there is a lot of behavioral content. Market cycles, at the beginning when there's an expansion, tends to allow for a lot of slackers, a lot of inefficiencies. And that kind of breaks at a certain point, which is why you have contractions. What does this mean for the little guy? Well, the problem is that not so much that it's efficient, it's that it's inefficient. We have an informational disadvantage. Just because you have access to information doesn't mean you can understand it as well as other people. And there is certain levels of information that the individual investor does not have access to. So, the two different schools of thought trying to take advantage of different market uncertainties is fundamentals. They try to look at what is the basic value in a company. They look at their earnings sheets. They try to look at all that, and they try to say, hey, I can analyze this better than others. So Warren Buffett is one of these guys. Technicals, they try to look at any sort of aberration in the market behavior. They pour over tons and tons of data, and they try to find just anything they can find, and they put in an algorithm, and they just chug their algorithm. It's estimated that between 60 and 90% of stock market volume, as in transactions, are actually done by computers. So, information. There's some certain information that's pretty easy for us to understand. This is the Case-Shiller Index. It's basically showing you home prices over the last 10 years in different cities. However, there's other information like information on credit default swaps, information on mortgage-backed securities. So they lump together thousands of mortgages and they put them in this one security that you can invest in, and no one really understands how it's going to work. So the game itself is actually quite imbalanced. There's something that's been considered illegal for some time called front running. where a brokerage, they can take your order and they can trade themselves. So what if they take your order and make a trade themselves beforehand? It's because they know how your trade is going to push the market. Well, that's an issue because they're just getting this, it's unfair. And nowadays, a lot of the brokerages, Merrill Lynch a couple days ago actually got fined $10 million only for front running over the last 4 years. So, and Goldman Sachs actually has a computer in the New York Stock Exchange which can get information in a few milliseconds and everything else. So, Claudia Demeter, don't rely too much on so-called experts. I wanted to show this. Can I show this?
You can show this once we're done.
Okay. Well, that's my last slide. So that is basic investing in a nutshell. And I wanted to use my cards, but I couldn't read them.